So this is the video I wish someone created for me when I was purchasing my first home. What's up guys, my name is Paul Uroma, and in this video I only have a few questions I want to answer. And the main one is, how do interest rates work for mortgages? How do they come up with that number, 4.5, 5.7, 6.5? And what are the factors that go into that number? This is very important to know, especially if you're buying your first home, or maybe not your first home, or you're just interested in knowing the fundamentals and the technical aspects of how mortgage interest rates work. I'll also be sharing some of the key things that I've discovered that were also pretty valuable. This is not just derived from information online. I've also am a real estate agent, and I've also had many lunches with loan officers that kind of helped explain these things a little bit better for me. So let's get started. So I am using my tablet. That just helps me organize my notes a little bit better. And if you appreciate the time that I put into this research, make sure to subscribe and put in the comments what other questions you might have about real estate, the stock market, or any other financial topics. So let's get started. All right, so how do interest rates actually work? I tried to make this video very simple and kind of, simplify the complexities of the mortgage-backed security market. And, the main questions, like I mentioned before, is how are mortgage rates determined and set? What are the factors that go into the mortgage rate for the lender, right? How does the lender determine, what interest rate to charge you for your mortgage? And also, are there any factors from the buyer side that can play a role into that final number? And also, I'm going to be highlighting some other things I wish I knew about mortgage and mortgage interest. So let's kind of get a full picture before we get started talking about mortgage rates specifically. There's the stock market and then also the bond market that I want to talk about, and this will become very important later on. So people, businesses, governments, they all have money, and they get money through various different ways, for example, in income. And you can do quite a few things with your money. You can spend it, you can save it, you can invest it, or you can give it away. So when it comes to investing, there are multiple ways you can invest, right? So you can put it in the stock market. And what does that essentially mean? Just to simplify things, I'm not going to go into all the details, but essentially when you buy shares of a company, you are a part owner of that company. And as that company grows, so are your shares usually grow with that because they become more valuable. So when you buy a piece of a company for $5 a share, and that company grew and, produced more revenue, you can now sell it to someone else for maybe $7 a share or maybe $10 a share. So that is stocks. But there's also a different market called the bond market. And this is where companies go to borrow money. And you can, not just companies as well, governments also use bonds to raise capital for the various different programs that they have as well. So a bond equals a loan, essentially. And usually, what does the investor get for lending out this money? They get a fixed return, usually like 3%, 5%, 8%, and that gets determined by the market and many different factors. But we need to know for right now that stocks means that you are owner of a company, and bond means that you are a loaner, or you are loaning your money to a company and or government. So talking a little bit about bonds, essentially, unlike stocks, bonds do not give you ownership rights. They represent a loan from the buyer, you, to the issuer of the bond, right? So it's essentially a contract between the company and you for a specific amount of money and specific amount of time and a specific rate as well, right? So bonds can be issued by companies and governments. They generally pay a stated interest rate. The market value of the bond changes over time, kind of like the share. The value of your contract changes over time, more or less, depending on the potential buyers. Bonds that are higher quality, usually, well-known names like Microsoft, Google, the U.S. government, more likely to pay you on time, generally offer lower interest rates. And then bonds that have shorter maturities, length until full repayment, tend to also offer lower interest rates. So let's talk about this a little bit. So let's just move from the perspective of the person loaning the money to the person receiving the money. As a business owner, you might want to raise capital for different projects, expanding your business, but you don't want that to cost your business. You want to borrow money at a cheap rate so that way you don't have to pay back more money than you need to, essentially, right? So you want to get the cheapest interest rate. This is kind of even when buying cars or houses, right? You want to get a lot of money from someone to loan you, and you want to pay them back as little as possible, right? Well, conversely to that, if you're the investor, you want to get as much money for your investment or for your loan as possible, and that's where the market comes in. This is how we have a market. Some investor might want to have a 5% return, and some investor might want to have a 4.9% return. And usually the company would want to go with the 4.9% because they have to pay back less money for the money they borrowed. So let's just kind of summarize this a little bit. There are entities, people, banks, institutions, businesses that have a lot of money just sitting around. They want to make more money, even more money with the money that they have. And they need somewhere to invest or put their money. So what are their options, right? We have stocks, we have bonds, but there are also other investments. So, mortgages, car loans, business loans, line of credit, all these are also loans. And that's somewhere where a business might want to put their money in. So why are bonds cheaper than mortgage rates? And this will I'll dive a little bit deeper as to why these graphs are kind of correlated, but not all the time. So a mortgage rate is essentially the interest that you're paying for buying a house. But a bond, and usually the market, or if you were to Google this, 10-year treasury yield, we're talking about government bonds, so government issued loans. So usually a government issued bond, right? That's what a 10-year treasury is you're giving the government your money for 10 years and you get a certain percentage of return for that loan. And so why is the bond cheaper than the mortgage rate? Well, think about it. Who would you give your money to if you had, for example, $10 million? Would you give it to the government, or would you give it to some individual that is looking to buy a house? That's essentially what the investors have to make a choice. And so if they give it to the government, usually that is considered a safer investment because the government is less likely to not pay them back. If the government stops paying investors money, then we have a lot of trouble on our hands, and the economy is usually not doing great, or the government is usually not doing great. But generally, the government is considered to be a safe investment. So that's why when you are investing or loaning your money to the government, you usually get a smaller return, but a safer return. If the investor gives you money for a house, that's usually a higher risk because you can stop making payments. You are more likely to stop making payments in case, you lose your job. So there's a lot of more risk involved. And how do they compensate the risk of giving you money? They charge you higher interest rates. So if they want to take on that extra risk of you not paying them back or not paying them on time, they usually want a bigger reward for that risk. And that's why usually mortgages have a higher percentage rate. But that tends to correlate because remember, this is a market. So if you have a lender that says, I will give you money for your house, so yeah, you can buy your house, but I want 7%. And then, another lender comes in and says, hey, we'll do the same deal, but I'll give you 6%. Usually the home buyer will go with the cheaper rates, kind of like any other business. But at some point that you will hit a bottom. For example, when the treasuries are around 4%, you won't have a mortgage rate of 3% because then it doesn't make sense. Why would I invest and take on all the risk of giving you money for your house at 3% when I can just give it to the government for 4% and not have to worry about this extra headache of you paying them back on time, because I know the government will always pay me back on time and I get a higher percentage. So that's how these things play out. And this is the spread between the 30-year fixed mortgage and the 10-year treasury yield. And you can see it's not always correlated. So sometimes the gap is bigger and sometimes the gap is smaller. And there are other factors that play into this role as to how big or how small this gap is. So let's take a look at that. But before we do, here are some nuggets of very valuable information that I've learned by having a mortgage myself and also working with other clients as a real estate agent. The first thing I've discovered is that the servicer is not usually who owns your note. So for example, if you're getting your bill from Wells Fargo, that statement that says, hey, you owe $3,000 this month for your mortgage. Usually Wells Fargo doesn't actually own your loan. They're not the ones who gave you the money. They usually are just the person who sends the bill to you. But behind the scenes, it might be an investor. It might be another bank. It could be also a government. They usually get charged a premium, right? By saying, hey, you are the one that gave the money to the buyer, right? Let's just say to me, I'm buying a house. I will charge the investor a small fee to do all the paperwork and make sure that money gets collected. And that's how usually the servicer gets paid. But there are cases where the bank actually is the servicer and the note owner. But usually what happens is your loan gets bundled with a bunch of other loans and then sold on the secondary market for investors to buy. So for example, I have $10 million. I want to buy some mortgage-backed securities because they, offer a higher rate of return for me. So, instead of buying just one, I'll just buy a little bunch of mortgages, resulting in that interest, like in a fixed income, passive income type of investment. So, banks don't usually keep your loan. We already talked about that. And how did they make money? They usually sell it for a fee. And this is kind of where the 2008 bank crisis comes in and how it actually all happened, because let me break it down. Let's just say I'm a bank and you need money. I create a loan for you to buy that $200,000, $300,000, $400,000 house. But I don't want to inherit the risk of you not paying me back. So I will sell this loan to another investment who will give me that $400,000 back so I can go make another loan. And then I will charge this investor, let's just say $1,000 for finding a borrower that they can give their money to. So the bank actually becomes more or less the middle person, and they just charge $1,000. If they help make a loan for 5 people in a month, that's $5,000 for them, and then they throw that investment into the secondary market and have someone else pay and fund your loan. So that's actually was very interesting. I assumed initially that the bank, if they had $10 million, they will loan out $10 million. But this industry gets a lot more complex, and that's why I was very interested in doing this research. Okay, let's keep moving forward. The other interesting thing that I did not quite understand, but was very interesting to dive into, is why does the mortgage follow the 10-year bond versus the 30-year bond? If you have a 30-year mortgage, shouldn't it follow the 30-year bond? So if I'm an investor and I can give you my money for 30 years, or I can give the government my money for 30 years, shouldn't that be a fair comparison? But no, because usually how long do people stay in houses? And they actually did their research and realized that, when you refinance, you're paying off that loan. Or if you move and you sell your house, you're paying off that loan. So usually loans don't actually last 30 years, either because you refinance and get a better deal, or you sell your house and you need to get a new loan to pay for your new house. So they determined that the average duration of a loan is actually 8 to 10 years. While they're giving it to you for 30 years, they're actually expecting only 10 years of payments before it gets paid off and they get their money back, and they have to reinvest. The investor has to reinvest that money again. And so that is actually why it's following the 10-year market, because you can see the different bonds. Remember, the shorter the bonds, the smaller the interest rates, except in our current economy where it's actually higher. This is called an inverted yield curve. So this is not the best example, but so usually the way it works is the longer you give your money to the government, for example, these are US treasuries, the higher the interest rates, because you're locking up your money for longer, right? So for a 30-year right now is 4.224, 10-year is actually cheaper at 4.0, and so on and so forth. So as you can see that there is a little bit of a gap between the 30-year and then the 10-year, and it was discovered essentially that the mortgage interest rate follows the 10-year closer to the 10-year than to the 30-year because of the reasons I already talked about. So let's keep moving forward. So what are some of the factors that that the lender needs to look at? And I pulled this from bankrate.com. This is a very interesting article. I'll leave the link in the description below. But one of the factors that really plays a big role in your interest rates, mortgage interest rates, is the economy. What happens in the economy and how those events affect investors' confidence influence mortgage pricing. Good and bad economic news has an inverse impact on the direction of mortgage rates. And that's why people come to me and say, hey, I heard, the interest rates are going to be falling, so should I wait to buy a house? Right? All those news about interest rates falling and interest rates rising play into people's decisions and how they interpret the economy and what kind of purchases or lack thereof they are going to make. So the economy plays a big role in the interest rates, and the market reacts to all these economies, and that's how the interest rate moves for the mortgages. When a national economy is robust, which means it's expanding, it's growing, there's job growth, higher wages, mortgage rates tend to increase because there's essentially a more supply, and investors have a lot more options to put their money into. So if they're going to invest it with you, they usually want a higher premium, so the interest rates go higher. At the same time, when there's not a lot of businesses don't want to expand. They actually don't need your loans because they're fine with their one shop. They're not planning to expand to two. Well, then investors have a bunch of cash that they can't move around, so they are willing to loan you that cash even for a smaller fee, and that's how interest rates go down. Inflation also plays a big role. So rising inflation limits customers' purchasing power, and that's a consideration that lenders make when setting mortgage rates. If they set 15% and no one can afford 15%, well, they're going to have to start lowering rates because there's no demand. The customer's purchasing power has got eroded through inflation. Maybe the price of rent and other purchases such as groceries went up where they can't afford that interest rates. So when inflation is elevated, investors commonly pursue investments that can beat or match its climb. So while they have to come down on interest rates, they also don't want to be lower than the inflation rate, right? So if everything is increasing at 3% per year, they're not going to give you a loan at 2% per year, because if they give you a loan at 3% a year, they're just breaking even, because inflation is a very interesting topic to also explore, which I won't get into this video. But essentially, if you want to make money, you have to make a higher percentage than the inflation. If you're making the same amount, your money is just worth exactly the same, because maybe the product that you can afford at $100 is now costing you $103 if there's a 3% interest rates. So if the company made $3 as well, they didn't really make anything because the product cost the same. the product you can buy, the purchasing power is still the same. So you didn't really make money in terms of purchasing power, right? So another big factor that lenders, take into consideration is the Federal Reserve, right? The Federal Reserve doesn't set mortgage rates specifically, but the policies makes a big difference, right? The Fed can raise or lower short-term interest rates, which indirectly affects mortgage rates, right? Because if the loans get cheaper, the mortgage rates have to get also cheaper because there's competition. As I explained before, it moves with the supply and demand of the borrowers and the lenders, right? And so the performance of T-bonds and mortgage-backed security play a role in the mortgage interest rates because mortgages are packed together into securities, like I talked about before, and sold as mortgage bonds. And it's the return investors demand to buy these bonds that dictate the general level of mortgage rates. And essentially, the investors kind of play a role in setting the mortgage rate price. All right, I already talked about this. This was very interesting, especially about the 30-year versus the 10-year, right? The 30-year mortgage are packed together into bonds on average, and they tend to pay out over a 10-year period as homeowners refinance, move, or otherwise pay off their loans early. Yeah, I found that to be very interesting. So let's take a look at some of the factors that a buyer can influence the interest rate, right? So when you go into the lender's office, or you call them up and say, "Hey, I need a loan. Can you give me a loan, and what is the interest rate?" They are going to look at some of the factors that pertain to you specifically, and based on that, the interest rate might increase or decrease as well. The first kind of big one that people always focus on is the credit score. And the credit score, essentially what it's trying to tell the lender is how good are you with paying back your loans, whether that's credit cards, whether that's cars or mortgages, right? That all kind of factors into your credit score, especially with history, and your utilization of credit cards. Are you maxing out your credit cards? All that kind of gets summarized into one number that the lender can use to see if you are a person that is kind of worth lending out to. And when I say worth, can the bank trust you to pay them back? Or if you are more of a riskier buyer. And that is what the credit score is trying to determine. So if you're an investor and you have someone with a 700 credit score and someone with a 400 credit score, you can still give money to the 400 credit score, but you would want a higher return, a higher interest rate. And that is why, if you have a lower credit score, you usually tend to pay higher interest rate. Another factor that comes into play is your loan to value ratio. How much are you paying down your loan initially with your down payment? So a lower loan to value ratio typically results in a lower mortgage rate. So if the house is $400,000 and you're financing $400,000, then that's considered more of a riskier loan, where if someone came in and say, "Hey, I just need $100,000, I'm willing to pay cash for $300,000, well, that is considered more of a safe investment. Another key aspect to watch out for is your debt to income ratio. I can't stress this enough. A lot of buyers want to buy houses, and they come to me and say, "Hey, Paul, I want to buy a house." But then they have a boat loan, a car loan, a bunch of credit cards. Bank or a lender is not going to give you more loan on top of that, because they look at the debt to income ratio as well. The higher your DTI, the riskier you appear to the lender. So if you only have the mortgage loan and no other debt, you are considered more of a safer buyer, as if compared to another buyer who has the car loan, the boat loan, the student loans, credit cards, and then they want to say, "Hey, I also want to borrow money for a house." That is considered more of a riskier buyer. Loan amount also plays into the cost. This was also very interesting. Whether you opt not to pay the closing cost fees up front, but roll them into the loan itself, so you can actually take the fees that it takes to close the house, the taxes. Usually the buyer doesn't pay the taxes, but all the other fees, the origination fee, all the closing costs, essentially, if you're able to pay that up front or on closing day and not roll that cost into your loan, usually you'll get a cheaper interest rate. But if you are rolling all those fees into the loan, the mortgage rates tend to increase because that's considered riskier. Also, property type. The occupancy status, such as the primary home, secondary home, or investment product, can also significantly impact the rate. If the home will be your primary residence, rate may be lower. The type of property will also impact the rate. This is quite interesting. So if you're buying a single family home, the rates might actually be cheaper than if you're buying, for example, a 2 or 4 unit dwelling or a manufactured home or a condo. Those type of loans tend to have higher interest rate because, one, they're a little bit harder to sell, and a bunch of other factors where an investor wants to say, hey, I will give you this money, but I want a higher return. So that was quite interesting to observe and understand exactly how these mortgage rates get determined. So to summarize, essentially, it's following the 10-year Treasury bond, and there's some sort of spread or some sort of premium on top of that. And that is based on a lot of factors ranging from the economy, inflation, and to something very specific like your credit score and the type of property that you're buying. So hopefully you found this research and the summary of how interest rates work informative. If you like this video, make sure to like, subscribe, and put, what was the most interesting aspect of it to you in the comments section below. Also, if you have any other topics about personal finance or real estate that you would like me to investigate, leave those in the comments down below. Thank you for watching, and I hope to see you in the next video.